Hi everybody, and welcome to the Tech and Venture Brown Bag. My name is Peter Propp. I'm the Vice President of Marketing at the Stamford Innovation Center, and I'm here with Skylar Fernandes, who is a venture capitalist over at Centripetal Partners. Is that right?
Yep.
You got to get closer and talk into the mic. So what we're here to do is basically cover different topics that have happened in the last week, and we're going to try to do this maybe on a monthly basis as we can fit it into our schedules. Why don't you just give a little bit of your background?
Yeah, sure, a little background. My name is Sky Fernandes. Work at Centripetal Capital Partners, venture fund in Stamford, Connecticut. I think we're probably the closest venture fund to the Stamford Innovation Center. We're literally across the street. And the kind of quick background on our fund, we've been investing since about 2004. We invest pretty much across all industries. We're very opportunistic. No specific industry sector focus. Whenever we make investments, they're typically between 1 to 3 million, and we'll invest usually up to 10 million in any one company. But we've invested in everything from nanotechnology to healthcare to energy to internet tech companies to even high-end pet kennels, one called Pet Paradise, where you can have your dog stay at a nice place with a pool in the shape of a dog bone. So really broad industries, and very much we're Series A. We try to do, well, we're not startup focused, we're really, if it's pre-revenue, it's usually about 6 months away from generating revenue. Otherwise, post-revenue, usually 6 to 12 months of revenue so far.
Excellent. So that gives you a perspective on the sort of stuff that Skylar looks at, and that's really, maybe we should just jump into a venture topic, because I think that's why a lot of people are here. They're not as interested in hearing the Vice President of Marketing for a startup incubator. But so I was doing some research, and there's been a fair amount of writing this week about basically a slowdown in the B2C venture space. That and it was especially clear that it's not as much about the angel round or the A round as much it is a slowdown in the secondary rounds. So one stat from this Wall Street Journal article was that only half of the 165 companies that raised money in 2010 were able to raise more this year, and only a quarter of the companies that raised money in 2011 were able to raise more money this year. Now, the second one might be due to the fact that they might have raised enough last year that they don't need to raise money this year. So maybe take on either of those.
Yeah, a few things on it. So I think we're certainly in a lot of VC activity. Certainly from 2 years ago, there's definitely a lot more venture capital happening for kind of seed and Series A investments. But you are finding, exactly what the reports are showing, is that the Series B and Series C, there wasn't as many of those. And I think that's probably for a few reasons. One is a lot of the internet companies that were invested in for their Series A, if you give an internet company a lot of times, 5-6 million, you probably don't need capital for a year or two. So you're not seeing them simply because of that. But I think on the other side, companies that did get their Series A year ago or 2 years ago, you are finding that the transition point from always Series A to Series B, that's always the transition for companies whether or not they're successful, right? Oftentimes you can raise your Series A funding with very little to no traction, but just the beginnings for clients. And if you're not proving yourself, getting that Series B and Series C can be really tough.
So is that really a measuring stick, like without knowing anything else? If you hear about a company and you hear they weren't able to raise, or they haven't raised more money, immediately you say, wow, they might not be doing so well?
Well, it's not always that. It can be, whether or not that sector's hot can certainly be a factor. Right. It can be who their Series A investors were. Mm-hmm. One of the things that you should always focus on if you are getting funded is you always want to make sure you have more than one investor for your seed or your Series A, because when it does come time to raise more capital, you want more people up to bat for you, where it's not just you, the CEO, raising capital and maybe one seed investor, one VC. Ideally, if you can have 2 or 3 that partake in the first Series A, you'll have a much, much better shot of raising your Series B round.
What do you think, and I want to get back to the venture topic, but I was just thinking about crowdfunding, and people are this whole idea of being a qualified investor, and in addition to the how much is in your bank book question, there's also the advice. If you want to be a qualified investor, be prepared to make several investments and be prepared to invest a second time, with any of those companies you've made a bet with. So I guess it's the same sort of situation.
Yeah, very same. And crowdfunding obviously is, we'll see over the next few months when you have some of these equity-focused crowdsourcing funds or crowdfunding groups really starting to launch and see how they work. Because you really only need one grandma saying, well, I didn't know that was going to be the case and I lost my $2,000. One mad grandma could cause some big press. And we're definitely going to have some mad grandmas out there. But the question is how you go about doing that. Obviously, crowdfunding is opening up the door where you don't have to be as much of an accredited investor as you did to invest in private companies prior. So the pool of capital is much larger of people that can invest. But the question is, who's going to be setting the valuations also for these crowdfunding groups? When you're at the very early stages, the valuations have to be a lot lower given the risk. And if you're not doing the right valuations, get ready to get hurt.
Right. So I think we're going to collect hashtags today, and my first is #MadGrandma. What about in the B2B space? Because the article in the journal was really focused on B2C. That's really where the slowdown is. The enterprise space is ascending. Am I right?
Yeah, you are, and there's I think there's a few reasons for that. If you're going from business to consumer, you have a little bit of the educational curve for consumers to really understand what you're doing, and so the marketing approach needs to be a lot larger and more difficult. But B2B has always traditionally been a lot easier to sell into. You're doing fewer introductions to actually get it right. You don't have to get millions of people signed up. You only need a few 10 to a few hundred. And there's a good a partner at RTP Ventures in New York. His name's Kirill. He does a talk on that. He doesn't invest in anything that your mom would understand. And the reason he focuses on investing in things that your mom would understand is the difference in the strategy of B2B versus B2C. It's not that companies that moms understand aren't great companies. It's that they're oftentimes just easier to implement business to business in the relationships that you need. It's a lot easier to get off the ground.
Right. And just another tangent off of that would be the trend of consumerization within the B2B space. A lot of apps, a lot of products that we start using as consumers have now made it in the enterprise. The iPhone basically killing off the BlackBerry is the biggest example. But I think just from what we're doing to start our business, there's an awful lot of very user-friendly apps that would have no use for a consumer, but they're awfully helpful, to do a to-do list, to do whatever. It's clearly a business function, but it's got a real consumery feel to it. So that must be where I would suspect there's a fair amount of growth.
Yeah, so utility, oftentimes people, what they do on a daily life is dealing more with what they're doing for work. So
Right.
if you have something that actually affects your daily activity of operating your business, you're more likely to use it.
Right.
But you start going into the things that you just do randomly, though oftentimes it all comes down to mind share. Right? How much of a given 24 hours, what's your mind share usually taken up of? And that's one of the reasons that Google search works really well for Google Ads, is that when you're searching plumber and you see an ad for plumber, it works really well. You click the ad. But if you're on a random website and you see a plumber banner ad, you don't click that because you weren't thinking plumber when you're on that random website, but you were thinking when you search. The same thing for consumer apps or versus business apps. Are you going to think, if even a company like TaskRabbit, are you randomly, if you're familiar with TaskRabbit, it's a place where you can post tasks for people to do things for you. If you have a bunch of CDs right there that you want to convert onto your computer, you could do it yourself. It would take an hour or two, or you could hire someone on TaskRabbit. It's just most people don't think, oh, I could go get someone to put my CDs onto my computer, and I could go schedule that for them to do it next week. You think, why don't I just do it right now? That's the mind share. You have that, you immediately want to do it. And that's where you find challenges, again, for consumer-facing things versus business.
Right. The task application that Meg, our marketing manager, just introduced me to is Trello. Is that right? Trello. It's fantastic, and it's very user-friendly, and it's clearly very thoughtful, but it's, I mean, all the bells and whistles look like a consumer-y app that might do something else. It just happens to be great for business, so
Yeah.
it's an interesting trend there. Okay, any questions on the sort of pure VC side from the audience before we move on? Jonathan?
Yeah, I just have one question, if this is the time for it.
Sure.
Kind of, what makes for a good partnership? Because when you're out looking for money, every VC is saying, oh, it's so much more than the money, we can help you, and then, 90% of the time that stuff never materializes. So, how do you evaluate a good partnership?
Yeah.
Let me just repeat that. Maybe it'll get picked up on the video here. So the question is, we know that when you're taking venture or angel money or any sort of money from an investor, everyone says get smart money, get money from someone who's going to be able to contribute to your business intellectually and with partners and connections. But how do you judge that sort of smart money?
It's a great question. It's a long answer, and I'll try to give somewhat of a long answer to it, not forever. There's so many different ways to think about the right partnership between a VC and an entrepreneur. The pitch from every VC is always that it's smart money versus just signing a check. And for sure, the worst thing you could do is just raise capital from people that will just give you money and not have anything behind that. For example, the difference between getting an angel investor and a VC is really the size of the capital first, right? You want to make sure that your partnership is one that's going to be longer than one round. If you get an angel investor, most angels can only do one round. You can't go back to them if you go through that $100,000 and you need more. If you go to a VC, the partnership becomes more like a marriage where you can come back and say, I need more money, right? And you have a little bit of a bank that you can keep going back to, not forever, but you have at least someone who's willing to support you for the next few years beyond just that first round because they have more capital put to work. So that's the first thing. The other one is the relationships. It's that, do you want a partner who can bring clients to the table, that can give key board members for you, key employees? You want to have someone that knows the space well and that can advise you. Again, if you're just getting $100,000 from your grandma, she probably, unless she was someone that started a tech startup in your exact sector, your grandma's not going to be very helpful in that end. It's that advice that they can give you to help go through the pivots that you're going to go through in that early stage. Every successful startup has usually gone through one big pivot before they find their ideal solution. You want someone who can go through that really challenging pivot sometimes to make sure you come out really nice on the other side. So I think it comes from relationships, how much capital they can put in afterwards, and also the personalities, right? You have to say, is this someone that you want to work with on a daily basis, and that you can be really open and honest with, and not feel that you always have to be giving them the good things that are happening, but you can tell them the bad stuff too, and you don't have to worry they're going to get mad at you. It has to be a very transparent, open relationship with that partnership. If you can't have that, don't go into getting money from them. It's a really bad way to start off. But a lot of our portfolio companies, some that are doing really well, we don't have to focus on as much. But the ones that are just starting or struggling, those are the ones that we have to be there, at their office every day during the week, or at least one day of the week. And if you can't sit with them and be friendly, what are you? It's more personality in the end. It's people that you're investing in, and that often becomes that soft relationship stuff is what makes or breaks companies. It's not whether or not you have the best business model in the world.
Excellent. Any more questions from the audience? Yep.
Yeah, David, maybe I have a question about, you mentioned crowdfunding, and I understand the SEC is involved in that process too. Can you speak to that at all as to what their role is in that future?
Sure. So the question is on crowdfunding and the rollout and what role the SEC is playing.
Yeah, so I know probably as much as most people that can Google, but I do know a lot of people that are also involved in some of the crowdfunding platforms. One's crowdfunder.com, probably have the best domain name out of all, by the way. But there's a bunch of them. The key thing is, what are the actual rules going to be on how much money you have to actually be making, how much investment you can actually make. So far, it seems to be that you'll be able to do about up to $2,000 if you make like $100,000. They're trying to keep it where, yes, you can invest equity into private companies, but still control that you're not overdoing yourself if you're making 100 grand. But the question is, how are they going to track you? What happens if you go to 5 different platforms and do 2,000 each? I don't know how they're going to track you yet. But they certainly want to open the door to more people, but at the same time limit how much you can do. Don't know much more beyond that. And also the question is getting the ability to launch a crowdfunding platform too. What kind of hurdles do you have to jump through to actually launch a platform like that? Also critical, because you don't want random websites popping up saying, hey, we can raise equity for random companies.
So using your crystal ball, when we are talking a year from now, and we're talking about crowdfunding that's been in place, say it's been in place 9 months, are we talking about a trickle of investment activity? Are we talking about 10% of the dollars that are invested in the market? Somewhere in between, somewhere more?
That's a great question. Well certainly if you, remember there was some statistic out there of how much capital, if you open up the doors to people that are investing their like IRAs or other capital,
right,
how much money could be potentially invested in crowdfunding. It's large multiples more than the current average capital dollars that are being invested. So the opportunity is large.
Right.
It's a question of how many people actually participate in that. Don't know on that, but I think that part of the crystal ball looking at it is seeing how things are already developing. And you have a clear distinction between the crowdfunding models that are real more marketing platforms where you're getting some type of physical good back. And it's almost a break even for those platforms. You're not getting equity or investing in debt in those companies. You're really just getting products back, like Indiegogo or Kickstarter. There's a woman named like Amanda Palmer that launched her CD, and basically you get a CD back because you helped pay for the production of that CD. She didn't really make that much money off of it. So they're more marketing platforms, but the ones that are being developed for equity and debt, it's a question of how they're actually going to use those. If they're going to do any type of, I'm really curious to see if there's any co-investment strategies where if you can raise, X number of dollars from a crowdfunding equity platform, then you'll get, a seed fund will match that. An interesting way of matching popularity to if a seed fund will co-invest with you. If you can get co-investing models to work, you'll really have something.
Well, I think that's a good idea. I was just thinking about the opposite of smart money might be dumb money, right? And there's a fair another hashtag, dumb money. So I think that it's very possible that if there was some sort of a way that you could or an attractive crowdfunding platform might be one where a seed fund or an angel fund has done the due diligence and opens up X number of slots.
Yep.
And then people basically try to fill those up as quickly as they can, assuming they like the business.
It's interesting if any of the incubators or angel groups would start creating their own crowdfunding platforms. I haven't heard of that yet, but that would definitely be
right, because it would be vetted. It would have more chances for success.
Yeah, one of the key problems actually, I talked with one of the crowdfunding platforms. One of the challenges they have is with regulations. They can't tell you which companies on their platform are better companies than the other ones, because then they're giving advice, and they can't suggest one more than the other. That's like they'll get into some really bad trouble if they start doing that as providing advice. So that's one of the problems is how do you filter through which are the better companies on crowdfunding platforms versus the worst companies? And the only way you can watch it is, well, which one has 80% of it almost there? Well, maybe those are the ones to look at, but that just tells you that they're more popular.
Right, but the name was better.
Yeah.
I think question in the back of the room?
Can you tell us what kind of things do angel investors and incubators look for in early stage companies, early stage ventures investors?
But the question is, what do angel investors look for in early stage companies? Is that right?
Yes.
If you ever talk to one, the quick thing they'll probably ask you is your valuation. And you really want your valuation to probably be around $5 million or less, preferably far less. So they're definitely looking for entrepreneurs that understand the world of raising angel capital and seed capital, so you can have a more open conversation with them. They're probably looking to invest in preferred shares, not common, and they're probably doing a convertible note. But what they're looking for in entrepreneurs is they want to know that you have the ability not just to execute, but you have the ability to raise the capital beyond the seed funds. They don't want to get stuck putting their $100,000 in and then they have to do all the hard work for you to raise $2 million. They want to know that you're capable of being a fundraiser outside of being a good executor on your business. But when it comes to looking at your business, obviously they look at all the same things that VCs do on the quality of the team, industry expertise, leadership experience, good business model, all that stuff. But it becomes more significant of whether or not you can get to the Series A, I think, when a seed investor is investing in you.
Okay, great. I'm gonna move on just a little bit. Maybe we can get some questions at the end. I do want to put in a little plug for what's going on in the state of Connecticut. The Stamford Innovation Center is one of 4 hubs within what's called the Connecticut Innovation Ecosystem. And if you want to learn more about the ecosystem program overall, you should go to ctnext.com. And that is sort of the gateway to a lot of different programs. They're going to ask, if you're a startup, they're going to ask you to register your business, so you'll get an ID and you'll go into their CRM environment. And by getting into that environment, that's the first step towards a number of benefits. The most exciting of which for a really early startup is a voucher program. So they will provide vouchers of about $5,000 a piece, and you can get at least one voucher. I think you might be able to get 2 to cover your expenses with different service providers. So if you need an accountant, if you need a lawyer, if you need someone to redesign your logo, if you need someone to design your social media program or get your Google Analytics set up just right, those are the sort of things that startups should be obviously looking at, all those things. But this program within CT Next is available to help you fund some of those things. So it's a grant. It's not a loan. It's not anything. It's just money the state wants to make available for people to get within the ecosystem, so we can start to nurture those sorts of companies and make them bigger. It's a pretty great program.
I didn't know that. That's great.
Yeah, that's good. Yes.
On that, are they only technology companies, or is it any kind?
That's a really good question. I mean, the focus is tech startups, but certainly you could make the argument for a broad set of companies that could, potentially have some sort of a venture funding and some sort of eventual cash event. So upstairs, just as an example, it's in the same realm. Connecticut Innovations has invested in a company that's just moving into one of our permanent spaces upstairs. They're called Personally Cool, and they have a product that's in the home healthcare category, and so it's a physical product that they think is going to be very popular for a certain demographic. And once they're here and we're announcing in the press release pretty soon, we'll hear all about it. But I don't want to describe it poorly, so I'm not gonna. But they received Connecticut Innovations funding, so that's a physical product. It's not a traditional web or mobile or whatever sort of tech startup. There is technology, but it's something you buy and put in your bag and bring with you on the road. So that's an example of a company that is certainly within the ecosystem and certainly could potentially have received those sorts of monies if they'd applied when they were a much smaller firm.